Ladies and gentlemen, here in this video, we will take a look at the warning that Tom Lee just gave about a potential recession, how the current administration in Washington could be actually trying to engineer a recession, what I think are the actual probable, odds of this, how to go about investing in markets when we're kind of in limbo. We don't know if we're heading into a recession. That doesn't mean you sell everything. That means there are some steps you can take to put yourself in the best financial position. And if you are a Tesla stock investor, the stock is already down 50%, and I will share with you my longer-term strategy and my view of Tesla based on all of this new information and what could ultimately come of Tesla stock. But first, take a listen to the warning that Tom Lee just gave about a recession.
Crosshairs.
I assume you don't see a bear market coming, like a full-fledged 20%er.
It's possible because it's been a couple years, but this would have to be because there has to be a layered shock on top of this. Like if the Fed, like for instance, if somehow the Fed decides that the economy's weakening, but they choose to fight inflation and let a recession happen. So in other words, the idea is, well, we've been wanting a recession to kill inflation, like let's just let it happen.
Yeah.
Then of course we're going to have a big drawdown. But that would really require a Fed that decided the employment mandate wasn't important because, a recession, once a recession starts, there's no such thing as like we can engineer a mild recession. I mean, it's like you could have a severe recession because you just don't know.
You did too much damage, and now things like it starts to feed on itself.
Yeah.
We're doing fiscal austerity at the federal level. At the same time, we're going to do this trade war. So that fits into that category of the shock that you're talking about.
If prices go up on top of all this, and we've got stagflation, then yeah, sure, we'll have a 20% bear market for sure.
Yeah. So I mean, you can see why people want to maybe start to be nervous and price it in.
In 18, by the end of February, the stock market was down, I think, 17%. And it happened really fast, just like this time. And people at that time were saying it's orderly. And they were right. It was. We bounced all the way back to the prior high, but then we got stuck there. The tariff thing was like sort of cooling off, but then we had another problem. I think we just kind of had this air pocket where corporate earnings weren't great.
Yeah.
Had a manufacturing recession for sure. And then by Christmas Eve, we were in another 20% drawdown. And the thing that pulled us out of it was Powell's about face. I think he gave a speech on Christmas Eve and he said, just kidding about the nowhere near normal thing. And then in the first quarter of 19, we were already cutting. So there was some of that going on. And so having like those two, call it almost 20% corrections inside of 1 year, that's pretty rare, but we did. We lived through it.
Yeah, and that was a first-term president that didn't have necessarily the administration he wanted to have with him because remember there was so much turmoil.
Yeah,
and it was a newly minted Fed chair.
Yes.
So today we have an experienced administration and a very experienced Fed. So
okay,
so like would the Fed even want to dabble with a bear market that could trigger recession? Like I'm going to just say, even if there's partisan issues involved, right? Because you've seen, I do think there's a partisan element to maybe some of the Fed talk. This would be, it would really blemish the history of the Fed. It would blemish the legacy of the Fed.
Treasury Secretary Scott Bessent basically said on Friday, we're going into a recession, a shallow one at least.
Top 10% of Americans are 40 or 50% of consumption, and that is an unstable equilibrium. The bottom 50% of working Americans have gotten killed. We are trying to address that. We're trying to get rates down, and could we be seeing that this economy that we inherited starting to roll a bit? Sure. And look, there's going to be a natural adjustment as we move away from public spending to private spending. The market and the economy have just become hooked. We've become addicted to this government spending, and there's going to be a detox period.
Now, history suggests the next 2 weeks are critically important for markets. take a listen to this. The NASDAQ 100 has officially ended its streak of 497 trading days above its 200-day moving average, the second longest streak in history. Yesterday, the NASDAQ 100 index closed below its 200-day moving average for the first time since March 12th of 2023. After the previous stretch of 450 days finished in January of 2022, the NASDAQ 100 lost 5.7% over the next 2 weeks and 22% over the next year. Every time the index has closed below its 200-day moving average after a long run and subsequently dropped over 3.5% within 2 weeks, a bear market followed, according to Sentiment Trader. On the other hand, when the decline was less than 3.5% within 2 weeks, the index saw positive returns over the next year. History suggests the next 2 weeks are key for the markets. Now, you also had some weird discrepancies in the jobs report that came out on Friday. As David Rosenberg highlights here, the most important metric in today's U.S. jobs report was the big move up in the broad U6 unemployment rate to a 4-year high of 8% from 7.5% in January. In other words, slack is building in the labor market, and that will lead to a deceleration in nominal wage growth. When that bumps against the tariff price shock, real take-home pay will decline, and a recessionary pullback in consumer demand will follow. This is where an initial inflationary shock ultimately morphs into a longer-lasting deflationary backdrop. Also, as James E. Thorne writes on X, the average hourly work week is a leading indicator. The only time it was lower than today was the global financial crisis. And Powell said on Friday, the labor market showed no signs of weakness, which really makes you wonder, is the Fed going along with this narrative and creating a policy error in real time, basically foregoing the economy to get rid of the last bit of inflation and, get back to business as usual on the other side of it? That's kind of what it feels like if you listen to the Fed officials over the last week. They don't sound concerned about the economy, although there's some big red flags out there. Challenger job cuts hit 172,000 last month, which is basically at like 08-09 recession peaks, okay? This is higher than where you were in, January of 2009, right? This is higher than where you were in February. Well, not February, March of 2009, or any other month in 2009 besides February. February did peak at 241,000. Other than that, this is higher than any other month you've seen during the global financial crisis. That is crazy, okay? You are at some of the highest levels you've seen in 2001. Like, this is a big red flag. And as Sven Hendrick writes on X, recessions are now called quote-unquote detox periods. That is in regards to Scott Bessent. Now, another big red flag for the labor market was the household survey showed negative 588,000 jobs, okay? And the only worst other, instance it has been this bad was January of 2024. You had like 700,000. Okay. Well, you had 151,000 in the BLS survey. I think the household survey is a lot more reliable, if you will. And this is not a good number. Now, the issue really is there is a lack of confidence in consumers because of what Doge is doing, for better or for worse, firing people, laying people off. There's 2 million government employees that don't know if they're going to have a job next week. That is going to really limit the excess spending that they are doing. That's going to slow down the economy. From a regional perspective, areas with a lot of government employees are going to suffer worse. But you also have the Doge cutting off funding for a lot of areas. It's really just eliminating the overspending in the government, as Scott Bessent said. But that creates a lot of uncertainty from a company level, right? I actually met someone that worked in the rail yard industry. He said his company is freaking out because they purchased millions of dollars worth of new railroad. I didn't ask specifically what it is. I assume it was, railroads. And the government had a contract with them and they pulled the contract after they already bought the supplies. So, his company was freaking out. I bet your ass his company's probably not looking to hire people with that kind of uncertainty, with that kind of volatility. And you can only imagine there's a huge trickle effect from that. And it is a confidence crisis in this country right now. Now, you also have a Fed that's not running to the market's rescue. They're going to allow some degree of weakness in the economy. And mix that together with tariffs, which again is a tax. Not great for economic activity, whichever way you want to put it. You have a bad dynamic right now. The question is, does this get worse? Does the government back off? No, it doesn't look like it. Reciprocal tariffs going into effect on April 2nd. As I wrote on X, this is the most difficult market I have ever lived through. 2017, 2018 trade war, 2020 COVID crash, 2022 bear market. Nothing comes close to right now. The problem is actually simple yet complicated. Can Doge, the flow of government stimulus, tariffs, and general uncertainties with consumers push the U.S. economy into a recession? Donald Trump says, quote, there will be disruptions. Treasury Secretary Scott Bessent says the economy is rolling over. Challenger job cuts came in at recession peak levels of 08, 09, 2001 at 172,000. Personal spending was negative. Retail sales were negative. Atlanta Fed GDP is tracking negative 2.3%. Household survey lost 288,000 jobs last month, all while the Fed is on pause because of fears of inflation via tariffs. The Fed could be making a policy error in real time. Tariffs are forcing businesses to halt investment in many cases, and Doge is creating a confidence problem. Is this enough to push the U.S. into a recession and create a bear market? Or is this just another growth scare and Trump will back down and it's business as usual again? Let me know down below in the comment section. The issue, and really the big question I've been asking myself, over the last 40 or 50 years, you don't just go into a recession, right? You don't just slowly grind down to a recession. That just doesn't happen these days. And recessions have gotten more rare over time. But the thing I struggle with is, could the combination of these factors be enough to push us into a recession? Now, I don't know the answer to that, ultimately, okay? Could it? I'm sure. Will it? I don't know. The problem I have with markets right now, and why I'm not super giddy to buy a 7% drop in the S&P, is because even if we don't go into a recession odds are going to rise. We will be forced to price in more recession risk, unless Trump were to back down on the tariffs, and inflation is unless inflation comes down, the Fed is able to accommodate markets, something along those lines. Is that going to happen? I don't think so, at least not overnight. Once there's, like a 20% drawdown in the S&P, I think a lot of people are going to change their attitudes here. But even like 2022, you had a 27% drawdown in the S&P. And I mean, a lot of other stocks were beaten down like bad, really, really bad. It starts with momentum first, and then it works its way into everything. Is a 7% drawdown enough to price in the recession risk? No, I actually think the bell curve is going to shift more, towards the left side, right? To a tail risk event, which is a recession. And meaning if we're not really pricing in too much recession risk to the headline S&P, what if that goes to 50%? How much downside do you need to see in the S&P? I do not know that, specific answer, but I do know it's more than 7%, right? Could it be 20%? It could be. Could it be more than that, considering the last 2 years have been really good? It could be. And that is the difficult part about right now. And it almost feels like, from a government perspective, like Trump and the administration, they're almost trying to push us into a recession. I mean, if they did it now, they could blame it on the Biden administration to kind of flush out, reset things, and then have the next, 2026, 27, 28 be good years. Get back to the private sector that really fuels this economy, not the public sector. It almost feels like they're trying to engineer a recession. Maybe that's just me, but that's what it feels like. Oh, and you also see that the trade war part 2 is now starting, what seems like. China imposes 100% tariffs on select Canadian imports. Also, putting like 25% tariffs on some of their poultry products. And you can also see on Polymarket, Kalshi, and other betting sites, the probability of a recession this year has surged in just the last couple of weeks. And I mean, again, you can even see from like what Scott Besson is talking about and Trump, and they're trying to bring down 10-year treasury yields. The best way to do that, my friends, is a recession. I don't know, just feels like they want to engineer a shallow recession. So really, when I think about all of this in regards to Tesla stock, the stock is already down a lot. It's already priced in a fair bit of recession risk. But if we did slide into a recession, there's going to be more pressure on the stock. Now, what I have personally been doing is buying a couple shares at a time. I'm not going all in at these levels because ultimately, if we did go into a recession, you could be, under $200. Some people are talking about $80 per share on Tesla. Now, I think that's pretty damn extreme. I think you'd need to see a severe recession. And long before we got to a severe recession, you would have interest rates at 0. You would have really a backing down from some of the current policy, administrative policies. I think there would be a lot of positives that came out of that as well. Now, for some of you guys that don't know this, everyone, loves the lottery, right? People becoming millionaires, almost every day. Recessions make more millionaires than lottery winners times 10 over the history of the lottery and over the history of recessions in this country. So if you are able to spot a problem, position for the inevitable outcome of that problem, you could make a lot of money. Now, I think there's an opportunity to hedge, especially if markets do bounce. Now, you could hedge in Tesla, but I don't like that because the stock is already down a lot. I want to be buying Tesla here, not shorting Tesla here. The headline S&P could make sense as a hedge. If we do bounce and volatility comes down a little bit, the pricing of options is super expensive right now. So if we get a bounce and people start to feel a little bit better about things, then I think the opportunity to hedge comes in, because the fact of the matter is the economy is going to get worse before it gets better. Jobs reports are going to get worse before they get better. And inevitably over the next couple of months, you're going to start to see those government layoffs coming in. You're going to see those challenger job cuts start to be reflected in the non-farm payrolls. And there will be a larger fear of a recession. And I don't think that is priced in the broader headline, S&P or even the NASDAQ down 10%. Like, I don't think you're really pricing in too much of that recession risk, maybe 10, 15% of that. You could need to price in a substantial amount more. Now, another easy way to play this is calls or outright buying TLT. Now, it's tricky here because, again, premiums are elevated for basically everything. The last couple of days, you have seen TLT sell off a little bit, and that I do think presents an opportunity. Now, TLT can do really well in the short term. Like, you can make 10, 20,000% returns on TLT if you get it at the right moment. Now, if you're in the trading community, that's one thing I will be specifically paying attention to. But if you have a lot of cash and you want pretty much a surefire way to hedge your portfolio and, do well this year, I think TLT is the easiest bet to make. Like, rates are going to come down, whether it's recession or it's, just the current trajectory of policy. Rates are going to continue to go down and TLT is going to continue to go up. But I do think, especially if we get a bounce and TLT sells off, potentially even more over really maybe this next upcoming week, let's say CPI is good or something, TLT is probably, that could actually make TLT go up. But again, if we bounce in markets, which is, I think, what could happen in the short term, an opportunity could be presented with TLT. So that's kind of the way that I'm looking at things. SPY puts when the markets bounce, or TLT calls. I think that's kind of the easiest way to look at this. I'm not a financial advisor. I'm not a financial planner. And what I do plan on doing is, again, Tesla continues to fall, as I think it will over the medium term here if the economy continues to get worse. And this is assuming that nothing changes, right? If the trade war were to end tomorrow, throw away this video. Now, unfortunately, I don't think the trade war is going to end very soon. I think it's probably going to get worse before it gets better. We have reciprocal tariffs on April 2nd, right? So assuming nothing changes, I think we're still under, downside pressure in Tesla, broader markets, basically everything. If something changes, then that's going to rework this entire situation. But I don't think it will, unfortunately. So I do think you want to be prepared for that. I think the second half of this year could be better than the first half if we avoid a recession. And that's kind of the hard part. Are these things going to push us into a recession? Well, maybe. Nothing's guaranteed. And that's why I think with Tesla specifically down so much, you want to take advantage of that. I mean, if we don't have a recession, somehow none of these policies seem to affect consumers that much, which I think is fictitious thinking, but it's possible. Then Tesla's going to do very well in the short term, over the next couple of months. So I think you also want to be positioned for that. And I think Tesla offers the best, kind of risk reward to this because it's already down so much. It's going to recover a lot more if we do ultimately avoid that recession. So those are kind of my thoughts here. Raising as much cash as possible, whether that's getting a second job or, taking back your spare change for a couple hundred, bucks. I know I have a lot of change. I don't know about you guys. That can make a big difference in some kind of crash event. And the good news is, and the reason I'm making this video so early, like we're very early in this, if we do go into a recession, is you're going to have some time. Okay. It's not going to be like the COVID crash where you have like 2 days to buy and then the markets are back up. If this does spiral into a recession, you're going to have some time here to go shopping, to continue working, continue saving money, and continue putting money into markets. The opportunity comes as stocks fall. I know people get scared. I know it's scary. As long as you're not in margin, you're fine, okay, ultimately. But there will be some massive opportunities, and you want to prepare ASAP for them. Again, if there's only a 50% chance of a recession, that could be such a big opportunity. You want to prepare for that. But you also don't want to, miss the opportunity that is presented in front of us if we don't have a recession. And that's where it's so challenging right now, trying to balance the risk here, putting money to work. At the same time, we know stocks could fall further. And I think you kind of want to do a combination of all of it. Put some money to work now, save some on the sidelines, buy some hedges maybe, if that's up your ballpark, and be ready. Again, not a financial advisor, not financial advice. Hedging is always risky. You can lose all of your money, hence the word hedging. You're hedging for something that may not happen. So contact a financial advisor. You know the disclaimers. I am not one. You could lose all your money, blah, blah, blah. So that's kind of my perspective. If things got really bad in Tesla, you could see Tesla back to about that $100 level. And that would obviously be like a crazy buying opportunity. I don't think we hit those levels. If we did, I mean, that would be something. Okay, that would truly be something for the history books, that's for sure. So again, let me know what you guys think about this down below in the comment section. Have a fantastic rest of your day, and I will see you in the next one.